Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Nicole Webb, Senior Vice President and Financial Advisor of the Wealth Enhancement Group, to discuss how retirees and those approaching retirement should be managing their assets and investments. Nicole, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. Happy to be here.
You got it. Let's start with the macro first. What are the current macro themes that are top of mind for you? It seems to be we're in the same place talking about the same thing.
Absolutely. To us, there's a little bit of the lingering question in terms of, do we continue to have bull momentum through end of year 2023? And if the setup today is pricing in too many rate cuts, as if we are almost in expectation of some systemic failures occurring in the short term. To us, we look at the Fed, and while we believe that they're most likely to pause and hold where we are, we actually don't see them backing down. It's not necessarily at all to the extent that is priced into the markets currently. So we see some lingering optimism that we could get higher from here in the face of the headwinds and challenges, but we don't believe what drives us higher is Fed cuts, not even in Q4 of this year.
So what is your macro outlook looking forward with the current backdrop? Because of course now the market is focused on what's happening in terms of the debt ceiling.
Yeah. So when we think about the debt ceiling, we think that there is a high likelihood that we are going to see increased volatility in the ultra short term. Unfortunately, we believe that history may repeat itself here, that we will play a game of kick the can a little bit too far. And similar to 2011, when we saw, negative 16% drawdown on the S&P in just 10 trading days, we don't think that's off the table. However, we do believe that we will get through. The lingering question is, do we push to that June 1st target, wait for June tax payments, June 15th comes around, hopefully then we can get through. And I think everyone is in anticipation of how rough will the end of May, early June be for investors. As we look out beyond the debt ceiling conversation, we do believe that the stickiness of the labor market will provide the stickiness of consumer resilience. And through that, we just don't see, unless something breaks, this expectation of wages going down, unemployment going up, and the Fed having to move, on failing financial conditions. And that's just not happening yet.
So it sounds like you don't think we'll see a recession in 2023.
I don't. I think you'll continue to see pressure on earnings. Right now, we're looking at productivity numbers being the worst that they've been since 1948. So even if we do get some marginal productivity growth, think about applications like AI driving margin expansion, the Chinese consumer, who has not really come back online yet, providing some of that to American domiciled business. I think that there's room for margins to grow a bit on the back of productivity. And then also, if we do start to see immigration numbers come back to pre-pandemic levels and provide some of that stability to the labor market, that will work against wage inflation. And so perhaps, yes, we really can have elements of disinflation where it comes down faster than we see financial conditions erode.
So how should retirees and those approaching retirement age, how should they be managing their assets and investments against this backdrop?
Yeah, the number one thing I would say to retirees, and how our advisors here are really positioning this moment in time, is that you have to get rid of kind of this media hysteria around risk on, risk off, and being a trader versus being an investor. People have to be invested for many possible outcomes. So to say, yes, we believe that there's heightened volatility in the short term because of the debt ceiling does not mean that one should fully remove themselves from the market. It's really a barbelled approach, looking at, yes, the ultra short-term T-bills are paying really high income, but at the same time, the 10-year and beyond is likely ahead of long-term growth expectations, which means it too, on the longer end, is quite favorable. Similarly, when we think about the interest rate environment or growth or duration stocks, one should still barbell against that a recession is likely to happen at some future moment in time. And so playing into, those aristocratic dividend value names have a place in your portfolio as well. And so, barbelling on all sides of investment themes in a way to believe that one can be agnostic of many possible outcomes in the short term while still being an investor for the long term, is really the conversations we're having most often.
All right, Nicole, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.